Good morning. We are going to finish up Chapter 7 today. We have a question up now. This question is not going to be open very long because we have another question coming up. So let's talk about this. We're in Chapter 7 today. So on Monday we talked about plant assets and the cost of plant assets. So this is just a review question from Monday. So what it's saying is the question at the end of what it's asking is, what's the cost of the land? So when we think about a cost of land, land includes the purchase price, it includes any real estate taxes we've paid, it includes any sales commissions, it includes the cost to grade and clear the land, including removing any buildings. Those are all costs included in the land. So as we review this, land is purchased for $543,710. Good. Okay, so that's the purchase price. That's clearly part of the cost of land. Back taxes are paid by the purchaser for $8,500, so that is part of the cost of the land. Total cost to demolish an existing building and clear the land were $215,000. That's part of the cost of land. But then we get to the cost of paving the parking lot, were $106,000. A parking lot is considered something we add to the land. It's added to the land. It's actually a land improvement. It will wear out, and it can be depreciated. So that's actually a land improvement, not part of the cost of the land. So when we're looking at this, it is the purchase price of land, the back taxes, the cost to demolish an existing building are all part of the cost of the land, not the parking lot. The parking lot is a separate asset. Land can never be depreciated, but parking lots can be. Why does that matter to me? Depreciation gives me a deduction on my taxes at the very minimum, and so I want to make sure that I can claim the deductions to which I'm entitled. So there's that one. Again, that question will remain open for maybe another minute or so, so you want to make sure you get signed in if you're just joining us. So Chapter 7 homework is due this weekend. Chapter 7 homework has, I think, about 4 questions on it. We did some on Monday. What I emailed out yesterday and is in an announcement on Blackboard are step-by-step videos on how to do each homework problem. We're not going to do each exact problem in class here, so if you want the extra help, refer to those videos. They're each fairly short, but it should be easy for you to go to for additional assistance if you need it. And again, I emailed those out yesterday, and they're also in Blackboard under announcements. Okay, exam 2, just a reminder, it's the week after next. Next week we're doing Chapter 4 and 8. Very doable because each of those is pretty small. We're going to do Chapter 4 one day and Chapter 8 another day. Very, very doable. The exam will cover Chapters 4 through 8 then, everything we've done, 4, 5, 6, 7, and 8. And we will do that next week. The reason I bring, not next week, we do Chapters 4 and 8 next week. The exam is November 2nd through 4th. The reason I'm bringing this up is if you're in Section 7 and 8, you probably want to schedule your exam with Proctor U soon so you get the best selection of times. And then just an aside, I'll talk about this more the week after the exam, but I just wanted to give you a heads up. I know several of you have already found it. There is an extra credit project for this class. And I'm not going to get into details today, but it basically is a project in my accounting lab. It's the Accounting Cycle tutorial, which basically, very briefly, is you record transactions, you post them, you create a trial balance, and you do financial statements. You do that whole accounting cycle. It is housed in my accounting lab. If you complete the entire project with a certain minimum score on it, you will get 2 percentage points added to your grade. So if you end at the end of the semester, you're sitting there with an 88 and you've completed the whole project and met the requirements, your 88 will turn into a 90. Okay, that 2 points is either the whole project or not. You cannot do 1 or 2 steps and get part of it. The extra credit is the whole thing. So I just wanted to point that out so that if you were thinking you might want to do that, that you might want to look at it and maybe get started. There's 10 steps in it. You cannot do it in one sitting. It's too long for that. This is 2 percentage points added onto your grade, so it is going to take some work. But if you're in a position where you need the extra credit, that's a great opportunity. If you are an accounting major, I absolutely positively would encourage you to do that, because that's an excellent review for future classes that you have in financial accounting as an accounting major. Or if you're a finance major, that would also be highly recommended. So we're going to talk more in a class about it probably the week after the exam, but I wanted to just point it out, so if you have a little bit of extra time, maybe start getting started on it, and we'll talk more about details. But the details are all on Blackboard. On the left-hand side menu, there is an option called Extra Credit Project, and it'll tell you what you need to know about it. And I think I've got a handful of people who have finished it already. So, and then I have a bunch more people who have started it. So know that that's fine. There's no harm in starting it. Okay, you're not going to be penalized for starting it, even if you ultimately decide not to do it. But we'll talk more about that next week, but I did want to say that that exists. So we're going to be talking about Chapter 7. We're on to our next question, and number 16. Now, number 16, I want to get so you have to think about this for a minute. Treating a capital expenditure as an immediate expense, what does that do? So let me give you an example of what I'm talking about. Let's say you buy a building for $1 million. Okay, so you spend $1 million on a building this year, and you're going to use that building for the next 30 years. So you have the $1 million. Typically, that $1 million would go, well, it should go on your balance sheet as an asset, okay? And then over time, you're going to depreciate it in future years. But that $1 million, when you buy that building on a very simplified level, you're going to be debiting building, which is an asset, and you're going to be crediting cash. Now, this question says, treating a capital expenditure like that building as an immediate expense. So what we're saying is, instead of debiting the asset, we would instead debit building expense, for example. So we have an expense. Now, assets go on the balance sheet, expenses go on the income statement. So what happens if you take your building that should have been an asset in the first year, and instead you make it an expense? So that's the question that you're answering. So go ahead, and I'm going to deliver that one now. So what we're saying in this question, so if you're still debating about it, let's say we have a building, and we should have put the $1 million in assets, building as an asset. And instead, we made a mistake, and we put it as an expense instead. So we have an expense instead of an asset. So what does that do to assets, net income, expenses, etc.? Waiting for about 20 more people. Time to commit to an answer. Okay, I want to, so on this question, again, what I'm saying here is I'm treating a capital expenditure. A capital expenditure, an example of that is I spent $1 million on a building. So that's a capital expenditure. When I do that, when I spend $1 million on a building, I'm going to be debiting my assets, okay? So that's what I should have done. Now they're saying in the question, I treated this what I should have done is I should have had an asset. Instead, I wrote, oh, I'm going to make it building expense. So I make it an expense. So just kind of walking here through this, I'm going to start at the bottom. Understates expenses. This question is saying instead of having an asset for $1 million, I made it $1 million of expense. That can't possibly understate expenses. That actually does the opposite. So it cannot be answer B, or D. Can't be B either, but wait. No, it can't be D. So starting at the bottom, we cannot possibly understate expenses. What we're saying is we overstated it. We overstated expenses. So it can't be C or D. So when we're talking about which answers it can't be, it cannot be C or D. So if the answer is C or D, you need to select a different answer. Okay? So now we're moving our way up. Now, I said that we bought this building for $1 million. It should have been an asset. We should have debited building. Instead, our mistake was to debit expense. So right there, we don't have an asset. So we have understated assets. So it cannot be A either. Okay? So we have, it can't be A, it cannot be C, it cannot be D. Okay? So I'm going to close the question in 5 seconds. Okay, so it overstates expenses. We have $1 million over an expense, and if we have too much expense, then net income is too low. So now on to what we're going to do today. So today we're talking about the process of depreciation. Depreciation is this process that allocates the cost over the asset's life. Now, this example of we spent $1 million on a building, we're going to use this building for 30 years. It doesn't seem right that we would spend $1 million this year, even though we're going to use the building over the next 30. So we're going to take that $1 million in asset, and we're going to spread the cost of it over the 30 years because we're trying to match the expense of the building with the revenues it helps generate. We're going to use that building for 30 years. It's useful for 30 years, so we're going to be spreading the cost of the building over the 30 years. It's going to put the cost of the asset against the revenues it helps generate. Depreciation expense is on the income statement, and just as a reminder, last time we said land is never depreciated, so that's just stuck in there as just an additional reminder. So depreciation, what? Yes. Okay, the question is the depreciation under the money it made you? Okay, the depreciation on an income statement, we've seen income statements before, they have sales minus cost of goods sold, okay? Depreciation is part of cost of goods sold or operating expenses, okay? Sales revenue is always first on the income statement, and then depreciation is going to be below there in the expenses somewhere. Yeah. So we don't put depreciation like against revenue, but it's in that same period. So we have revenue and then expenses, and depreciation is one of the expenses. Yes, and that's what we're going to do. We do not specifically account for sales revenue from that asset, because that asset may not have directly generated sales revenue. For example, a building that we use for human resources, that doesn't generate sales revenue for you, but you used it so you could exist as a business and you were generating revenue all those years. So you don't have sales revenue specifically associated with an asset. You're just saying, since we're using it for our business in general, we're going to spread the cost over all those periods we use it. And typically mostly we're talking years. At this level, we're just going to say years, but yeah. Okay, so what it's not. Depreciation is not valuing an asset. A lot of times people use the word depreciation like I drive a car off the lot and it depreciates. Well, the meaning of depreciate there is talking about the sales value of the car. That's not the accounting terminology. Depreciation is a process of spreading the cost over the years that we're using it in a methodical way. It doesn't have anything to do with cash. So sometimes we think depreciation is a way of setting aside cash. It has nothing to do with cash. It's just allocating costs to the periods in which revenues are being generated. I'm not speaking right now. I was waiting for people to quit writing, so thank you. Okay, so today we're going to talk about how to measure depreciation. And to measure depreciation, we need to know 3 items. We need to know cost, useful life, and estimated residual values. So the first one, cost. Cost we did on Monday. So cost was the purchase price plus real estate taxes if we're talking about land, installation costs, whatever those costs are, we given cost. Next one is estimated useful life. Estimated useful life is how long we plan to use this asset, how long it'll be useful to us. It might be expressed in years, it could be expressed in miles, in hours of use, or some other measure. So we have to be given estimated useful life. Yes. We'll get to that. In units of output, this machine might be rated to make 20,000 widgets. Okay, so it just depends. It's some way that this equipment wears out. Like a car. A car unit of output is miles, right? So that's units of output. Not till it breaks down as how much we're going to use it for. Okay, so it's our estimated useful life. So let's just say, I'm going to switch back to years now, but let's say we buy a car. We buy cars for our salespeople, and we say the estimated useful life of this car is 5 years for us because we want our salespeople to drive it. We want them to drive a fairly late model. We don't want them driving beaters. So we're going to say every 5 years we're going to replace the car. So the car is useful to us for 5 years. So the estimated useful life of that car would be 5 years. Even though the car still runs at 5 years, it's saying that at the end of 5 years, it's not going to be useful to us anymore. So we might sell it, we might trade it in, but we estimate our useful life as what it's useful to us. That does not mean it's not useful to anyone anymore. It just says this is how long we plan to use it. So it's not completely broken down. It's just this is how long we'll use it. Okay, estimated residual value. Estimated residual value is also known as scrap or salvage value. I use the term salvage value and residual value interchangeably. There's no difference between them. And this is the expected cash value of an asset at the end of its useful life. So this is going back to the car example. This is where we say we know we're going to drive our cars 5 years, and at the end of 5 years, we're going to sell them. And we can get a pretty good estimate of what we think that'll be worth in 5 years just by knowing about how many miles we put on the car. We can look and see what 5-year cars of that make and model are worth right now. So it is an estimate, but we estimate what that's going to be worth at the end of its life. Again, we don't say that we use assets until they're absolutely worthless. We're saying here's how long we plan to use it, and here's what we think it'll be worth at the end of the the estimated life. The residual value, the estimated residual value or the salvage value is not depreciated because we're going to get it back, presumably. We're going to sell it for its estimated residual value. And again, these are estimates, and at the end, we won't get into that. But there's ways that if it doesn't exactly balance at the end, there's gains and losses. But we're not doing that. We have something called depreciable cost. Depreciable cost is how much we are able to depreciate, and that is our asset's original cost minus the estimated residual value. Okay? This is how much we can depreciate. We can never depreciate the residual value. So we're going through a lot of terminology now, a lot of concepts now, but we're going to go through examples coming up pretty quickly of how this all affects us as we do the calculations. There are 3 depreciation methods. We're going to go through all 3 today. We're going to go through straight line, units of production, and double declining balance. A company will pick a depreciation method and stick with it. A company can pick different depreciation methods for different classes of assets. It may decide to use straight line depreciation on its automobiles and may use double declining balance method on its computer systems, for example. So, but once you pick a depreciation method, you stay with it. You don't change year to year. We're going to go through all 3 methods today, but before we do, a little more terminology. If we take the original cost of the plant asset, subtract accumulated depreciation, we will come up with the book value of the plant asset. Okay? So original cost less accumulated depreciation is going to give us our book value. Okay, now, accumulated depreciation is a contra asset, and a contra asset works the opposite of a asset. It's always shown with its asset. So we have plant assets, you will always see accumulated depreciation with it. It will reduce the original cost to get our book value. So that's a contra asset. And the accumulated depreciation is the running total of all depreciation for that asset or for the group of assets. So it's a running total. Since it is a contra asset, accumulated depreciation has a normal credit balance, and it will always offset plant assets. The book value of a plant asset at the end of its useful life, the book value will be equal to its residual value. If an asset has a 0 residual value, then the book value will be 0. Otherwise, it will be its residual value. It'll always be its residual value, whatever that might be. You have to know how to calculate book value. Okay, so something might ask you for the book value. Book value is always the original cost less your accumulated depreciation. Your depreciation expense is the expense for a year. The accumulated depreciation is this running total of depreciation through time. It's on the balance sheet. It's a contra asset. Okay. As an asset is used in operations and depreciated, the accumulated depreciation will go up and the book value will go down because you have the original cost less accumulated depreciation, so your book value will decrease over time and the final book value will equal that estimated residual value. Okay. So what we're going to do now is we're going to go through all 3 methods. So we're going to use the same basic set of facts 3 times. So the first method that we're going to do is going to be the straight line method. And the straight line method has an equal amount of depreciation assigned per year, and our depreciable cost is divided by the useful life to get our annual depreciation expense. So what you're doing is you're saying, here's my depreciable cost, divide by the number of years, and that's how much depreciation expense you have each year. Okay, so we have the set of facts. What we need out of it is we're using the straight line method, and we bought a used delivery van on January 2nd, 2014. January 2nd is important to us because it tells us it was at the beginning of the year. January 1st, 2nd, 3rd, 4th, that's all the beginning of the year. Later today, near the end, we're going to be talking about what to do if you buy something July 1 or October 1st or something like that. We're always going to use full month depreciation in here. All my examples today will be full year, and then we do have an example of a partial year. So this is we don't do depreciation on a daily basis or anything like that. It's full year or months if we have a partial year. So the original cost is $13,000. The useful life of the van is 5 years. So this is the useful life to this company. They've determined that. And then it says that the estimated van's residual value would be $1,000. Okay, so we have to prepare a schedule of depreciation expense. A schedule of depreciation expense is not a financial statement. It's just going to be so we can see how the different things change. Accumulated depreciation, depreciation expense, book value. So that's what we're going to do. So those numbers that I circled are going to be what we use, the $13,000 original cost, 5-year estimated useful life, and the $1,000 estimated residual value. Okay, so on this slide down at the bottom, I'm going to start by putting our basic facts. So the first one, this is just a formula. So first thing, original cost less residual value or salvage value gives us depreciable cost. So if we're going to apply the numbers here to that, that's going to be $13,000 original cost less the residual value gives us depreciable cost. Residual value and salvage value are interchangeable. The terms mean the same thing. Now, so we figured out our depreciable cost. Now the next step, we're going to calculate our depreciation per year. Straight line depreciation, simplest method we have. Basically, you're going to take your depreciable cost, divide by the number of years, and you're done. So it's going to be our depreciation expense is going to be our depreciable cost divided by our estimated life. So here, we will take $12,000, which is our depreciable cost, divided by 5 years to give us $2,400 per year of depreciation expense. Okay, now we're going to do a depreciation schedule. And I'm putting it all up here, and let me show you what we've done here. Since it is the same amount per year, we're going to have each year listed per row. Our depreciable cost is the $12,000 we calculated here. And that $12,000 will be the same every year. Our annual expense will be the same every year. What does change is the accumulated depreciation. The accumulated depreciation for year 1 is our annual expense. For year 2, it's going to be last year plus this year. And then for year 3, it's going to be the $4,800 plus the $2,400 will give us $7,200. For the next year, it's $7,200 plus $2,400 gives us $9,600. So accumulated depreciation grows every year. The final column, the book value. The book value will always be our original cost. Our original cost was $13,000 less the accumulated depreciation each year. So a straight line, this is very straightforward because our depreciation expense per year is $2,400. As long as we have a full year, $2,400. We'll come to in a little bit, we'll do an example where we bought an asset partway through the year and we make an adjustment for that year. But other than that, straight line is going to be the same amount every year. Your accumulated depreciation goes up over time, book value goes down over time. And that's what straight line, very, very straightforward. Okay, so what we're going to do now is we are going to do a question where you get to calculate depreciation. So, okay. So before I push the question out to you, I want to walk through it. So on January 1st, Fargo Company purchases the car for $32,000 with an estimated life of 4 years and a residual value of $4,000. What is the straight line depreciation for year one? And that's what is the straight line depreciation expense for year one? I'm saying how much straight line depreciation expense would there be for the first year? Okay. So I put it out there. So go ahead and make the calculation. As a hint, you do have to do some mathematical calculations. You can't just grab a number that's in the problem. So what you're doing on here is when we talked about, back here, I'm going to go back to the question still open. What you need to do on this question is you need to first of all calculate, your depreciable cost, which is going to be the original cost less the residual value. So you're given your original cost, $32,000 less the residual value of $4,000, so you get a depreciable cost. Then you take that depreciable cost and divide by the estimated life. You're taking the $28,000 dividing by the number of years of life, and that's where we're going with this one. So you've got about, so again, you're taking that $32,000 less the $4,000 residual value, and you're going to divide it by the estimated life. That is going to give you the depreciation for year one, the straight line depreciation expense for year one. And I'm going to close this in about 10 seconds. For those of you who have answered D, remember that you cannot just take $32,000 and divide by 4 years, okay? You've got to take the $32,000, subtract the residual value, okay, and then divide, okay? So the answer cannot be D. Closing in just 10 seconds or so. Okay, and that answer, overwhelmingly, the correct answer was $7,000. That's your $32,000 cost less the $4,000 residual value divided by 4 years. So that's the straight line depreciation. Straight line depreciation is going to be the same every single year, unless in the first year or the last year you have a partial year. But otherwise, straight line is just the same every year. Okay, so next up. So now we're leaving straight line and going to units of production. Units of production can be used when your equipment or your item wears out over time based on some usage. A common example is miles driven. So you might say as a company, we drive all our cars 100,000 miles and then we're going to trade them in and get something new. Aircraft are typically rated for number of hours used, hours on the engines, and so that would be their life. Printers have a certain number of copies on the drum, and that would be their life. So only certain assets can use units of production. So units of production is going to be a fixed amount of depreciation is assigned to each unit of service, and the depreciable cost is divided by useful life, and to get it, basically, you get your depreciation per unit expense times the number of units gives you depreciation expense. We're going to go through an example where we'll go through how you calculate this, but you take your depreciable cost, divide by the number of miles or hours you have, whatever it is, and then to get your depreciation expense, you take that per mile times the total miles or something like that. This will become a lot more clear as we go through an example. I have an example. We're going back to the delivery van, so we have miles we'll be using. So units of production can be used when we have something that wears out based on some measure. So we might have hours, we might have miles, number of copies, those kind of things. We're rated for something. So we're going to do one of these coming up. We're going to go back to our Ralph's Pizza example. We're going to see all these numbers in the next page so you don't have to write them down. It's the same. We bought it for $13,000. We bought it, and when we bought it, now they're telling us it has a life. We're going to use this van for 100,000 miles, and then it tells us our estimated residual value is 1,000, and then it tells us how many miles we're going to drive it each year. And again, you'll see all these numbers coming up. I just want to point them out that those are all numbers that are given to us. We say, well, gee, we spent $13,000 on the van, has a $1,000 estimated residual value. 100,000 miles is its life, and then here's how we're going to drive those miles. So we're going to do a depreciation expense table. So depreciation expense, it would be good. We're going to do a schedule because it's going to be different every year now. So we're no longer like straight line where you can just take it and divide and get the same amount each year. So we're going to have a column for miles driven, a column for rate per mile, gives us our annual expense, and then we'll have accumulated depreciation and book value. So you want to set up your table to look like that. Okay, so we have our table done. The first thing we're going to do is figure out our depreciation per unit of output. Now I put depreciation per unit of output. It's depreciation per mile because they're telling us that we're using units of production and they give us miles. So that's depreciation per mile. So how we're going to calculate that is we're going to take our cost, our original cost, the van cost us $13,000. We're going to subtract the residual value of 1,000. So we'll have 12,000. We're going to divide by the 100,000 miles. This is the life they gave us. They said our estimated life of our van was 100,000 miles. So what that tells us now is we have depreciation expense of 12 cents per mile we drive the van. That's what we're doing here. So 12 cents per mile. Yes. The question is, even if we bought the van used, does it still have 100,000 miles? Yeah, and these are all facts that are given to us. I mean, maybe it's got 10,000 miles on it to start or whatever, So yeah, so it doesn't, whether it's used or not, the company makes a determination of how many miles they'll use it for. Okay, so we got 12 cents per mile. So basically what we're going to do with the units of production method is we're going to take our miles for the year and multiply by the 12 cents. That's how we calculate depreciation. So what we'll see in 2014 is 12 cents a mile times the 15,000 miles driven. So they gave us how many miles were driven each year. We'll be given that, and that's where I filled in the table. So for year 2014, 15,000 miles times 12 cents gives us $1,800 annual expense. So that annual expense, that's our depreciation expense for year one. So our accumulated depreciation for year one is a running total of all the depreciation to date. We don't have any prior to this, so it's $1,800. And then our book value is our original cost, the $13,000 minus that $1,800 gives us $11,200. Okay, so for year two, 2015, it tells us we drove 30,000 miles. So 30,000 miles times 12 cents a mile is going to give us $3,600 of depreciation expense. Then I'll take my depreciation expense of $3,600 and add it to $1,800 accumulated depreciation from last time, and I get $5,400. So that's my $3,600 plus my $1,800 accumulated depreciation last time, and then my book value will be $13,000 minus the $5,400 to get me $7,600. So over time, our accumulated depreciation gets larger, our book value gets smaller. So 2016, we drove 20,000 miles. Again, they told us how many miles we drove times the 12 cents is going to give us $2,400 of depreciation expense in year three. And then my accumulated depreciation will be the $5,400 depreciation from last time, add our depreciation expense this year, and we get $7,800. And then my book value will be $13,000 less the $7,800 or $5,200. So I'm going to do the next 2 years the same way. I'm going to fill them in, skip ahead here. Now, something to note, this will be the same with straight line, it'll be the same with units of production. Any method we use, at the very end, the book value will be equal to the residual. So that $1,000, our residual value, our book value at the very end of the life, at the end of the estimated life, will be equal to the residual value. Okay, so that is units of production. We can only use units of production if we have some way to measure wearing out. So we have a vehicle, we can drive it miles, we have a machine and it's rated for so many hours. You couldn't use units of production on a building typically because the building wears out over time. You don't really have some way to measure. So units of production can be used in certain circumstances, but the majority of companies will use straight line depreciation for their books because it's simple, it's straightforward, and they use the assets over time and they think it reflects well. This depreciation is one area in which you can make one choice for your financial statements. So you can say to yourself, I think straight line depreciation reflects our usage over time. I'm going to use straight line on my books. I think that's the best picture of reality, whatever reality is. And then you can use, the tax code calls for a different method. The tax code actually uses what's called an accelerated depreciation method. So when you do your taxes as a corporation, you can use an accelerated depreciation method, which we're going to go through next. The method that we go through next is not an exact match to the tax code, but it gives you an idea. So you can use one method for your books. It doesn't have to match what's on your taxes. Because again, the tax method is chosen by the government based on the revenue collections they want to make. It's not based on what's the best information for your investors. So there's a difference. So companies can have two different depreciation methods. So the last method, double declining balance method. Double declining balance method starts by writing off a much larger amount early in the asset's life. It is, not sure what I think I edited this wrong. Okay. Here, cross out this part. This is an accelerated depreciation method. I edited the slide between class and it didn't make sense what I ended up with. Okay, so this is an accelerated depreciation method. And we're going to be calculating basically, roughly, it's twice the straight line rate in the first year, and it'll take a lot more depreciation early in the life of an asset. A company would choose to use this method if it felt that its assets were most useful in the early years and declining later. For example, if the company has a specialized machine to make a particular chip, that electronic chip, that is going to be very popular for a year or two and then not as much later, they might use an accelerated depreciation method where they say, oh, we're really generating a lot of revenue in the early years and less in later years, so we'll use a double declining balance method. For taxes, the government allows companies to do an accelerated depreciation method. The reason the government does that is because they want to drive investment in businesses. And as a business, if you say you can write off more depreciation in the early years, that's great, because if I can write off more depreciation early on, I reduce the amount of cash I need to pay on taxes early on, and with that money I save early on, I can reinvest it and make more money. So even though the depreciation over the life of the asset will be the same, I'd rather have the heavy deductions early on because they reduce my taxes, reduce the amount of cash I need to spend out, so then I can take that excess cash and reinvest it. And that's why the government allows companies to use an accelerated depreciation method on their taxes, because the government, in addition to collecting taxes, wants to generate investment. They want companies to invest. That's how we grow the economy. So the government has said you can use an accelerated depreciation method. On your taxes, not your taxes, but if you were to do a company's taxes, the tax rate, the tax method is known as MACRS. It's Modified Accelerated Cost Recovery System. So it's not exactly double declining balance, but you will get the idea. So what we're going to do is we're going to go through an example. There is a double declining balance factor that we use. This is the formula. I put it at the bottom. 2 divided by the number of years. Okay, it will always be 2. Every year I get people saying, why is it 2? This method is twice the straight line factor. A straight line factor of depreciation, think about when you do straight line depreciation. You take your investment minus the residual value, divide by the number of years. So you're taking, and you're doing that one, so you're just dividing, it's 1/6. So every year, if you have a 5-year life, you're going to take 1/5 every year is what it works out to be. So you have 1/5, 1/5, 5 times, and that's straight line. Double declining balance says you can take twice that. Your factor is twice that. So we'll take the straight line factor of 1/5 if we have a 5-year life, and we'll make it 2/5. Okay? So your factor for how many ever years you have for double declining balance method will be 2, because it's double, the straight line method, divided by the number of years. So it could be, if it's 4-year life, it's 2/4. And if it's 5-year life, 2/5, it would be 2/6 if it was 6-year life. So it's always 2 divided by the number of years. So where did I get the 2? I got the 2 from double declining balance. For our purposes, we will always use double declining balance. It's possible to have other, in this class, we will always have double declining balance, so it will always be a 2. Okay. Okay, so we're going to get started now. In just a minute, the double declining balance method differs from the other methods in 2 ways. The first year depreciation is based on the assets for full cost. In the first year you do the double declining balance method, you do not deduct, you do not subtract the residual value. It's the only method that doesn't include the residual value, doesn't deducted in the first year. Doesn't reduce, doesn't take the depreciable cost. It takes the full original cost times this factor in the first year. The final year in double declining balance is a plug figure. Basically, at the final year, you want your book value to be equal to the residual value, so the last year you're going to take the difference. And again, we're going to see this in the example coming up. So this will hopefully make more sense in a few minutes when we do apply it to our delivery van. So we are going to do an example, the delivery van again, and just to refresh on the delivery van, it cost $13,000. It had a residual value of $1,000. It had a 5-year life, and it was purchased January 2nd, so there was no partial year to worry about. Okay, so we're going to do double declining balance method next. So again, we bought it for $13,000. Life of the van is 5 years, and residual value is $1,000. So we're going to do a table to do our calculations since we're doing more than 1 year. The first column is the year. The second column is the beginning book value. The third column is declining balance rate, annual expense, accumulated depreciation, and book value. First thing we have to do is get our double declining balance rate or double declining balance factor. We're doing this percentage that we need. It's 2 divided by the number of years in the life. So it's going to be 2 divided by 5, 40%, or 0.4. So we get that, and we get it one time, and then we can use it throughout the problem. So it's always going to be 2 divided by the number of years of life. So we'll start. The book value, the beginning book value for 2014 is the original cost. So that original cost is $13,000. Remember I said that the double declining balance rate, or double declining balance method, is the only method that does not take into account the residual value in the initial calculation. So $13,000 times 40%, okay? We're using our factor, times 0.4, 40%, gives us annual expense of $5,200. So now our accumulated depreciation for year 1 is $5,200. That's all the depreciation we have. And our book value is our original cost of $13,000 minus $5,200 gives us $7,800. So you see we have a lot of depreciation in year 1. We're taking 40% of the book value. In year 1, it's the full cost. Now, for year 2, the beginning book value for year 2 is last year's ending. So we'll have the $7,800. So that $7,800 we ended last year with becomes this year's beginning book value times 40%. Will give us the depreciation for this year, which is $3,120. Our accumulated depreciation will be last time's accumulated depreciation plus the depreciation expense for this year. So $5,200 plus $3,120 will give us $8,320. The book value at the end of the year will always be $13,000 minus $8,320, which is $4,680. Okay, so it's always the original cost less the accumulated depreciation balance for this year. So for 2016, book value is, beginning book value is last year's ending, so $4,680 times 40% gives us annual expense of $1,872. Accumulated depreciation, we're going to add that to the $8,320, get $10,192. And I'll get book value of $2,808. So for 2017, we're going to take the 2,808 times 40%, gives you annual expense in 2008 of $1,123. Our accumulated depreciation is last year's accumulated depreciation plus this year, so we get the $10,192 plus the $1,123 gives us $11,315. To get our book value is always the original cost minus the accumulated depreciation. So in 2017, it'll be $13,000 minus $11,315. Okay, so that book value will always be the original cost less the accumulated depreciation on this line. So we will get $1,685. Okay, so now we're down to the last year. In the last year with double declining balance is always a plug figure, meaning we have to back into it. So beginning book value for 2018 is last time's ending book value. Okay? Now, our residual value, let me remind you, our residual value is $1,000. So basically we say, what's going to take to get from our $1,685 down to $1,000? Because our ending book value always has to be the residual value. And in this case, it's going to be $685. Now, if we were to do the math, if we were to take $1,685 times 40%, that would be $674. It's not exactly right. There's some rounding in there. So, but what we need to do on the last year is we need to plug it. So where we do that is we take the beginning book value for this last year, $1,685, subtract the residual value of $1,000, and that's how we got to $685. The accumulated depreciation will be $12,000. That will be the total depreciable cost, and then our ending book value is $1,000, which is equal to our estimated residual value. So that last year we always have to plug it because of rounding and other factors that come into play here. We can never depreciate something below its residual value. That plugging, it will not happen to you. I can't see this happening to you, but the plugging could also happen in year 4. If it's a huge residual value, it could actually kick that plug figure into year 4. So, but for your purposes, it's going to occur in year 5. Okay, we have, so far everything we've done depreciation for full years. There is, if we buy an asset partway through the year, it has to be adjusted in the year of purchase. So let's say UPS purchased a warehouse building on April 1st for $500,000. The estimated life is 20 years, and its estimated residual value is $80,000. So compute the depreciation. So when you do a problem, and this will impact your homework, by the way, you will have some problems that are not a full year. So look for the time when it was purchased. This was purchased April 1st. So the first thing you do is figure out a full year's depreciation. Okay? Full year's depreciation, we're using straight line here. It would be the same with double declining balance. You figure out a full year's depreciation. You will never have to make an adjustment for units of production, because units of production, you're told how many miles you drove it. You don't need to adjust those. It tells you actually for the portion of the year you owned it. So full year depreciation, we know that a full year depreciation in this case is $21,000. It's original cost less the residual value divided by the number of years, so it's $21,000 a year. Now, it told us we purchased April 1st, and we have the end of the year, December 31st. So that's 9 months we owned it. We owned it 9 months a year. We did not own it January, February, and March. So what we're going to do is we're going to take the $21,000, multiply it by the portion of the year that we owned it. So we'll take $21,000 times 9/12, and that'll get us our depreciation. So you have to cut the depreciation down to the portion of the year that you actually owned it. Okay, so you have to adjust if you use a double declining balance or straight line if you have a partial year. Your depreciation is always done on months, not on days, not on partial months, so it'll always be. And many of the problems, it's just a full year. So January 1st, 2nd, 3rd, 4th, those are all considered, it's a full year. But we do not do depreciation on a daily basis. Okay, so comparing the depreciation methods, straight line. Straight line is for an asset that generates revenue pretty much evenly over time. The vast majority of companies use straight line. So straight line is the most frequently used method for financial statements. Disney uses straight lines for some of its assets. You would have to look at the financial statements of a company, and when you look in the notes, it'll tell you what depreciation methods they use. Pardon me? Yeah. Yeah, it's just, depreciation method isn't something we're going to be able to pick for a company. That's a choice the company makes, and we don't know on the outside looking at a company what depreciation method it uses until we open up its financial statements, and it'll tell us. So it is not an obvious. It's not like we could say you use straight line. Disney probably uses a combination, but they know from surveys of companies that the most frequently used method is straight line. Okay. Okay, units of production is best when we have assets that wear out. So we have assets, number of miles driven, number of hours used. This doesn't mean that companies have to use it. Again, more companies are going to gravitate towards straight line because it's simpler, it's easier. If you use units of production, you have to keep track of how many hours used in each year, etc. So, but units of production is used enough that we still need to mention it. Yes, the problems will, Morgan, so the problems will tell us which method to use. Yes, absolutely. You will be told what method to use. Just as an aside, if you would ever get a question and it doesn't say, you're safe going with straight line. If it's not, because straight line is so common, but it will tell you what method to use, yes. Okay, and then double declining balance. This is best for assets that generate more revenue early in the life. So that's a choice a company will make. Okay, now for those of you that have written this down already, well, for everyone, I'm pushing out a question right now, and this is based on units of production. So I'll leave this up for a minute or two, but if you're done writing, I have pushed a question out, learning catalytics for you. And let's walk through this one together. We've got 72% correct right now. That's great. But for units of production, what you first need to do is get the depreciable cost. So if you've got a piece of paper to the side, you might want to keep track of calculations. The cost of the equipment is $11,000. It tells us that the estimated residual value is $1,000. So conveniently, our depreciable cost is a nice round $10,000. Okay, so that's our depreciable cost. It tells us that the estimated life of the equipment is 2,000 hours. So if on your paper, if you wrote $10,000, divide by 2,000 hours, that will give you $5 an hour, right? Okay, so now we have $5 per hour. That's our depreciation rate. So for every hour that we use the equipment, we're going to have $5 of depreciation expense. So we read further, and it says Peggy's Cafe uses the asset 300 hours. So we had a rate of $5 an hour times this 300, and so very good. We're pretty good. So you end up with 1,500. Again, the calculating the depreciation rate is first. So you first need to calculate the depreciation rate, and that's what I'm doing here. And then once you get the rate, you use it to multiply by the actual hours you use. Okay? Remember the Chapter 7 homework's due this weekend. I sent out emails with step-by-step videos on how to do the homework if you need it. Have a nice weekend.